Chapter 13, Corporations, Organization and Capital Stock Transactions. Corporations can be classified as either not-for-profit or for-profit. The ownership is either privately held or publicly held. The advantages of the corporate form of business include the business is separate from the owner, the limited liabilities of the owners, the stockholders, transferable owner rights through the sale of shares of stock, the ability to raise capital by selling shares of stock, the life of the business continues even if an owner or stockholder dies, and the regulations imposed by government. These government regulations can also be considered a disadvantage. Another disadvantage associated with the corporate form of business is additional taxes, where not only the corporation pays income taxes, but the owners, the shareholders, pay taxes on dividends received by the corporation. Finally, owners are not able to participate in the business because of corporate management. Stockholders have the right to vote in the election of the board of directors, as well as other items that require stockholder approval. Some companies pay dividends to their shareholders. If the company liquidates, the shareholders have a right to share in any amounts left over after creditors have first been paid. Let's look at some terminology associated with stock issuances when corporations sell their stock. Authorized stock is the amount of shares that the corporation has been approved to sell in the future. Issued stock are shares that the corporation has actually sold. Treasury stock are shares of the company's own stock that the company has gone into the marketplace and bought back. Outstanding stock are shares of the stock that are actually out in the marketplace. Outstanding stock is calculated as issued shares minus treasury stock shares. Corporations can issue or sell their stock directly to investors or indirectly through an investment banking firm. Factors that influence the issuance price per share include anticipated future earnings, expected dividends, the company's current financial position, the current economic state, as well as the current state of the securities market. Shares of stock can have a par value associated with them. Oftentimes it is a very small amount per share. Though many companies do have stock with a par value, many states do not require a par value. Stock can be no par or can have a stated value in place of a par value. There are two primary sources of equity. One source of equity is paid in capital, which represents the amount received from the issuance of a company's stock. There are two types of stock, common stock and preferred stock. The amounts recorded to these two accounts are calculated by multiplying issued shares by the par or stated value. Amounts received over the par or stated value are recorded into the paid in capital in excess of par account. The second source of equity is the retained earnings account that reflects net income that a corporation keeps or retains in the business. In this slide, we will examine the journal entries related to issuing par value common stock for cash. The illustration involves an issuance of 2,000 shares of $1 par value common stock. If 1,000 shares are issued for $1 per share, the journal entry will reflect an increase or debit to the cash account for $1,000. Because there is an increase in common stock and owner's equity account, the common stock account is credited. The amount recorded into the common stock will reflect issued shares of 1,000 multiplied by the par value of $1. If the other 1,000 shares are sold for $5 per share instead of the $1 in situation A, The journal entry to record the issuance is a debit to cash for 1,000 shares multiplied by the issuance of $5 for a total of $5,000. The credit to the common stock account is once again calculated as issued shares of 1,000 multiplied by par value of $1, resulting in $1,000. The journal entry is not in balance at this point. The $4 per share amount over the $1 par value is recorded into the paid-in capital in excess of par value account for $4,000. Now, total debits of $5,000 equals total credits of $5,000. The stockholders' equity section of the balance sheet reflects the two primary sources of equity. The first primary source is paid-in capital and contains the common stock account listed first. Remember, this account reflects issued shares multiplied by par or stated value. The paid-in capital in excess of par value account shows amounts received from the issuance of stock that are over the par value amount. Hydroslide received $6,000 in total from the issuance of the 2,000 shares. The second source of equity is retained earnings. Totaling the paid-in capital and retained earnings results in total stockholders' equity of $33,000. Companies that repurchase their own stock have treasury stock. Treasury stock reduces total stockholders' equity. There are many reasons corporations buy back their own stock. The company may want to have shares available for employee stock compensation plans. Repurchasing the shares can enhance the stock's market value. Companies may purchase their own shares for the purchase of other companies. Treasury stock reduces outstanding shares, resulting in a higher earnings per share. Treasury stock is a contra stockholders' equity account and therefore has a debit balance. Because it is a contra stockholders' equity account, treasury stock reduces total stockholders' equity. Meade's balance sheet reflects common stock of $500,000. Remember that this amount is issued shares multiplied by par value. Meade's common stock is calculated as 100,000 shares issued multiplied by the $5 par value, resulting in $500,000 of common stock. At this point, Meade does not have any treasury stock because issued and outstanding shares are both 100,000. Adding retained earnings of $200,000 to the common stock arrives at total stockholders' equity of $700,000. If Meade acquires 4,000 shares of its stock for $8 per share, the journal entry on February 1 will reflect an increase in the contra stockholders' equity treasury stock account for $32,000, calculated by multiplying 4,000 shares by $8. The cash account is decreased or credited for $32,000 as well. The balance sheet after the treasury stock transaction shows treasury stock at the bottom of the stockholders' equity section. The treasury stock cost of $32,000 is subtracted in determining total stockholders' equity of $668,000. Note the numbers of issued, outstanding, and treasury shares are disclosed. The $500,000 of common stock is recorded at shares issued multiplied by par value, 100,000 shares multiplied by $5 par value. The 96,000 shares outstanding are calculated by 100,000 shares minus 4,000 treasury shares. If a corporation sells treasury shares, the accounting treatment will differ depending whether the shares are sold above or below cost. In both cases, total assets increase because cash is collected, and stockholders' equity increases because treasury stock a contra stockholders' equity account decreases. Let's take a look at the treatment if treasury stock is sold above cost. Meade purchases 4,000 shares of its own stock at $8 per share. The journal entry on February 1 is an increase or debit to the contra stockholders' equity account treasury stock for $32,000. Because the cash is decreasing, it is credited. On July 1, 1,000 shares of the treasury stock are sold for $10 per share. The journal entry on July 1 is an increase or debit to cash for $10,000. Because treasury shares have been sold, there is a decrease in treasury stock. To reduce treasury stock, the account is credited for the amount of the cost, 1,000 shares times the $8 cost per share. The amount over the cost is recorded as an increase or credit to paid-in capital from treasury stock. A gain or loss, an income statement account, is not recorded on treasury stock transactions. If a corporation sells its treasury stock shares below the cost when it was acquired, the accounting treatment will differ. Meade has 4,000 shares of treasury stock that it acquired at $8 per share on February 1. As illustrated on the previous slide, Meade sells 1,000 of these treasury shares for $10 per share on July 1, resulting in paid-in capital treasury stock of $2,000. If, on October 1, Meade then sells 800 of these treasury shares for $7 per share below cost, the following journal entry is recorded. Cash is increased or debited for $5,600. The paid-in capital treasury stock, if there is a balance available, is debited for the difference between the cost of $8 per share and $7 per share. This amount calculates to $1 times 800 shares, or $800. The treasury stock account is reduced or credited at the cost amount of $6,400. The T account activity for paid-in capital treasury stock reflects the activity affecting it. An increase or credit of $2,000 on July 1 when the treasury shares were sold for more than cost. A debit or decrease for $800 on October 1 when the treasury shares were sold for less than cost, resulting in an ending balance of $1,200 on October 1. Please note that treasury stock is a contra stockholders' equity account with a normal debit balance, but paid-in capital treasury stock is a stockholders' equity account with a normal credit balance. Continuing on with the accounting for treasury stock below cost that involves the previous transactions of an acquisition on February 1, a sale above cost on July 1, and the sale below cost on October 1, the treasury shares now are 2,200 shares. The 4,000 acquired less the sales on July 1 and October 1. If on December 1, Meade sells its remaining 2,200 shares at $7 per share, the journal entry recorded on December 1 will include a debit or increase to cash for the cash received of $15,400. The paid-in capital treasury stock will be debited or decreased for the balance on hand of $1,200 shown on the previous slide. The remaining difference between cost and selling price of $1,000 debits or decreases retained earnings. Treasury stock is reduced or credited for $17,600. Remember, treasury stock always reflects the cost amount. Preferred stockholders have preference over